Friends, this is 10:05 in the morning. Welcome all of you to FinIdeas webinar on smart wealth creation ideas. We will start our webinar on time and we target to finish it on time as well. So, thank you to all of you for attending the webinar. So, here we are. We will just put in the first set up the objective of today's webinar. I will just give you a brief. All of you can participate in the webinar using the chat box. If you have any query, you can write it there. We will take up your queries as and when possible, or we will resolve them at when we start the FAQs. Okay. So today's objective of the webinar is we are going to understand how we can invest in index for long term, how we can be protected against market fall. Today market is at the top, probably it will make more tops or it may go down as well. So this is the one of the biggest fears people have in market. So today safety becomes very important for all of us to understand. So how we can add equity to safety and achieve prosperity. So this is the third objective that we are going to tackle. Then we are going to understand what are the benefits of leverage, and finally we are going to understand the whole index long term strategy. So these are the objectives that we are going to handle in this webinar. Friends, we are FinIdeas. We are a SEBI registered investment advisor. Before starting the webinar, this is the risk disclosure. Equity markets are subject to market risk. Before taking any financial decision, we will advise you to discuss the whole thing with your advisor, with your SEBI registered investment advisors. Okay. So, about us, we are a SEBI registered investment advisor. We are dealing with more than 75 members of exchange, NSE and BSE. We are the 26th company of India to get approval for our own algorithm. So we get the execution done through algorithms. We have trained more than 19,000 traders across India, and the number has been growing. Okay. This is our mission. We in FinIdeas work with a mission of providing transparent solution to everyone for achieving financial freedom. So this is what we are targeting. We believe whoever comes in connect with us should achieve financial freedom. This is our vision. We envision to manage wealth of rupees 6,000 crores and serve HNIs and members of exchange globally by 31st March 2023. This is the vision that we are working with. In these three countries we are present. We are present in India, Dubai, and USA. And all these cities, if you are looking for any local support, if you belong to these cities and you're looking in for any local support, we can very well get you connected with our teams there. Okay. Since lockdown, we have conducted more than 120 webinars. We had got 21,000 plus registrations, and we had participants who were more than 13,000, and we have added a AUM of 30 crores. Now, the objective of sharing this slide is we want to envision on people have after lockdown. We believe technology has played a very big role. We will suggest all of you to use as much technology as you can in your business, whatever business you are into. Okay. Now we will start with an understanding of index long-term strategy, which is having a low risk and high risk return strategy. Okay, friends, whenever we talk about investment, one of the foremost thing that we generally come across with all the investors that we meet, we find that property is one of the biggest components or is a major component of their investment portfolio. Now question is, why do we have this kind of confidence in property? I believe all of us, if you will check your value of your house, your office, your factories, whatever you have, you will find that out of your total net worth, 50, 60, 70% value is comprised of property. Now question is, why do we have that kind of a property? So when we analyze various people, we found majorly the answers revolve around two answers. One, property never becomes zero, right? So this is the confidence we have, that if we have invested somewhere in property, we know it may rise in price, it may fall in price, but it will remain with you. It will never become zero. So that is the first confidence that we have. And the second confidence that we have is sooner or later it will grow in price. Maybe today there is some recession in property market and the prices are not rising, but we know for sure 3 years, 5 years, 10 years down the line, they will come back to their prices and they will give you returns. Right? So this kind of confidence we have in property, and this is why we do invest in property. Now, when we go to equity markets, there is no such confidence. In equity markets, scripts very well become zero. I mean, scripts which are worth 300 rupees 3 years back are worth 35 paisa today. Right? So this kind of things happen in equity markets. So here we have very high risk, and we do have high returns as well. You will find scripts which has been giving around 18-20% year on year for last 25 years. That kind of scripts we do find in equity markets. So given this, we as an advisor, we decided we are not going to trade in individual equity. So where do we advise into? We trade in indexes. Now, what is an index? Okay, why Nifty index? Now, what is Nifty? Now, Nifty is the top 50 market capitalization shares, average of top 50 companies, right? What does that mean is today India's number one company is Reliance. The second number is HDFC Bank. Third is TCS. And that way we have a total 50 companies which are there in the Nifty portfolio, right? So if you purchase Nifty, what you are actually purchasing is you are purchasing a share in the portfolio of those top 50 companies, and it is always top 50 companies. I will just elaborate it a bit. If you know, there were some companies like Satyam Computers, Arcom, Yes Bank, which were there in index. Satyam was at its time it was 40th largest company of India. It was in index. Later on, there was some problem in Satyam, right? And as soon as its value went down to 51, it was automatically removed from index. And whichever was the 50th largest company at that point in time got into index. Are you getting my point? So what you know for sure is if you purchase Nifty today, you are holding top 50 companies of India. After 10 years also, you are just holding Nifty, but your portfolio will automatically be comprised of the top 50 companies of India after 10 years. Are you getting my point? So for that, if you look at the analogy, you will understand that Nifty may rise in price, may fall in price. That is not the argument. But the point is Nifty will never become zero. Are you getting my point? Give me a yes. Everybody. You can write on chat. Are you getting my point? The idea is if we invest in Nifty, the first confidence that we get is it will never become zero. Right? Okay. Now we move ahead. We analyzed a bit more. We understood that today India's largest company, Reliance, is worth around 9 lakh crores. HDFC Bank 8 lakh crores. TCS 6 lakh crores. Right? So around the total portfolio was worth 90 lakh crores and index was at around 12,000. Now, question that we need to ask ourselves, and we ask to ourselves, you need to ask yourself that today in 2020, India's number one company is worth 9 lakh crore. Now, question is after 10 years, whichever is the biggest company of India, whichever is the top one company of India, should not it be more than 9 lakh crores after 10 years, 15 years, whatever, right? So we have got an understanding that logically it should increase in price, right? So yes, right? So if this increases in price, right? So this 90 lakh will increase in value and eventually this 12,000 will increase in value. So what analogy we got from here is that property had two major confidence. One, it will never become zero, and second, sooner or later it will grow in price. Now, if you look at Nifty has also these two same confidences. One, it will never become zero, and second, sooner or later it will grow in price. If you look at the data, we'll see the data as well in the later part of the presentation, where you will identify that had you held Nifty for anything more than 3 years, your Nifty price was at least that much or more than that. So if you hold it for 3 years, you know for last 20 years this has happened that if you invest at some place in Nifty and hold it for 3 years, your price is at least that much or more, right? So these two confidence we have in Nifty. Now this presentation is divided into three parts. This was the first part of the presentation, which says that this is the investment vehicle we are going to follow. Why Nifty index? Okay. Now, friends, this is the first poll for you all. Why I'm putting in poll, so that you can, so that we have an understanding of what kind of level of understanding you people have. So, have you done any investment in equity or mutual funds till date? So, this is the um, poll at your screen. I request all of you to vote. Okay, great, great. So I can see results coming. Two people are, four people. Okay, great, great, great. So I will end this poll in around 30 seconds. You can all very well please vote, so that we can understand what kind of understanding you have, and accordingly we can have the presentation. Okay, great, great. So most of you I can see have participated, have invested in equities or mutual funds. That is very nice. Okay, okay. Okay, fine. So we have a few people who are not invested in equity markets. Fair enough. Still, you will be able to understand the whole product. Thank you. So I'm ending the poll in just 4, 3, 2, 1. Thank you, friends. Okay. So we have around 88% people who have who have invested in equity and mutual funds. Thank you. Okay. So now, when you have invested in equity, you will understand that if you invest in direct equity, your risk is pretty high, right? But when we moved on to index, our risk reduced, our risk was low. We as a team, we understood that our investor wants even lower risk. So what we did, we added equity with safety, so that we can achieve prosperity. So how did we do that? So what we did, let's say we purchased Nifty shares at rupees 10,000. We immediately purchase a downside protection, because the risk in equity market is it may fall in price. If it increases in price, you earn profit, right? So the risk is you need to protect yourself on the downside. So what we did, we purchased a protection for 1 year at 5% per annum. It's around this cost that it comes into, right? So what we did, we paid another 500 rupees. So in all, our total cost is 10,500. So what people are purchasing at 10,000, we are purchasing at 10,500. But now what we know for sure is that even if market goes from 10,000 to 5,000, and we have invested 1 crore rupees, it can never go below 95 lakhs. Are you getting my point? So now the most important risk that we have in equity market has been allayed. You don't need to worry about it now, because what you know for sure is maximum risk is now 5%. Okay, so now this looks good. Now there is a problem when you pay a premium, as in, say for example, in mediclaim, right? The one of the biggest problem, yes. Okay, Anandji, what I'm simply saying is, what we have done, I will just re-explain in a moment. What we have done is, we have purchased Nifty at rupees 10,000, and we have purchased a downside protection or at rupees 500. Okay, so what we know for sure is, now our total cost is 10,500, and what we know for is that if market goes from 10,000 to 5,000, your value, if say for example you invested 1 crore rupees, it will never go below 95 lakh. Your maximum risk is the 5% premium that you have paid. Is this clear now, Anandji? Is this clear? Give me a yes. Everybody, everybody, everybody. Yes, yes. Okay. You can post to everybody, so that, okay, great, great, great. Fine. So now the question is, if somebody pays a premium, there is a pain that he faces. Now, pain is something like, for example, you pay a mediclaim. What you know is that if you keep on paying a premium and you're not getting anything back, there is a pain every year that you are paying. So that pain may come here as well. Let's say, for example, you invested 10,000 today, and after 4 years, market is still at 10,000, right? It is possible, okay? Now you will keep on paying 500 rupees. So net net, what will happen is, after 4 years, you will be down by 2,000 and market is still there. That is possible. Give me a yes. Is this clear? The question is clear. Yes, yes, yes. Right. So if this may happen, what we did, we thought, let's analyze this. Okay. So what we did, let's say in 2020 market is at 10,000, and after 4 years also market is at 10,000. Okay, and you invested 1 crore rupees. So now let's say within 3 years, 2021, 22, 23, I took some numbers. Let's say market went from 10 to 12,000, it rose. Then it could not sustain, it fell down to 8,000. Again it rose to 12,000 and it went back to 10,000. Okay, so I took some numbers, and in the first year, because we work only with protection, we paid rupees 5 lakh for protection. Okay, now market went from 10,000 to 12,000. There was a rise of 20%. So your new value of 1 crore will be 1.2 crore, right? It will increase by 20%. Okay, now what we will do is in the next year, because now our value is at 1.2 crore, we will protect 1.2 crore. So we'll pay another 6 lakh rupees as a 5% of 1.2 crore. Okay, so now what we have is, if market goes up, your value increases, but if market goes down, your value is protected. Now from 12,000 to 8,000, market went down. So your new value of 1.2 crore will be 1.2 crore. Are you getting my point? Everybody, give me a yes. Is this clear? Why it will be 1.2 crore? Because this is going to be one of the very critical point when you are understanding the product. Okay, thank you, Aman. Yeah. So what will happen is, market goes down, but your value is still protected. Why it is protected? Because we have paid a premium of 6 lakh rupees to keep it protected. Right? Now when it market is at 8,000, your value is at 1.2 crore, you again pay 5% and your value is still protected at 6 lakhs. Now again, your contract is, if market goes down, your value is protected. If market goes up, your value increases. Now market goes back from 8,000 to 12,000. So around there is a rise of 50%. Okay. Now market increased by 50% and your portfolio value also increases by 50%. So it becomes 1.8 crores. Is this clear? Everybody, give me a yes. Everybody. Okay, okay, yes, okay. So now market has increased by 50%, your value has increased by 50%. Now again you will protect your 1.8 crore. So you will pay another 5% of this, so 9 lakhs is paid. So now from market 12,000, market goes back to 10,000. Your value is still protected 1.8 crore. So what we have seen is, if market goes from 10,000 to still at 10,000, your value increases from 1 crore to 1.8 crore. Now 1.8 crore is not correct, because we need to reduce this cost. So it is like 6 plus 6, 12 plus 5, 17 and 9, 26. Okay. So you have 1.5 crore, 54 crore. So still market remains same, but we grow. Yes, yes, right. So that's the point to understand. Now, if this happens, now these were my hypothetical numbers. Okay, from 10 to 12, 12 to 8, 8 to 12. But if you look at the last 17 years, you will find that across these 17 years, Nifty has increased by 12 times. It was around 11,000. It went to 12,000 in the last year. Okay. So it increased by 12 times. But if somebody has invested in this strategy, wherein if market goes up, your value increases. If market goes down, your value is protected. Your investment value returns becomes 17 times, right? And even more important point is the risk. If you look at Nifty, you will find there have been years when Nifty has fallen by 52%. I mean, your portfolio was worth 1 crore in the beginning of the year and went to 48 lakhs at the end of the year. Look at the pain of losing the value. While here, your maximum loss had been 5%, right? So this is very important. This is very important to understand. Okay, so generally what people say is that if you don't take high risk, you don't get high returns. We believe this is a very wrong statement. Had this been correct, you people probably are connected with many people who give credit to people, right? So for example, somebody is in let's say textiles, okay, and he's selling on credit to somebody for 3 months. Now ask him to sell the same thing for 3 years credit. What will happen? His risk has increased, right? But will his returns increase? Probably not. Why? Because after 3 years, probably he won't even see that person. There is always a smart calculation involved in their business. They know that this person is worth a credit of 3 months. He has a good credit, so he sells him at 3 months. This person had defaulted on payment last time, so I will give him only on cash. This person is not a good person. I will ask an advance payment, then only I will start working on this. Yes, yes, right. Why? Okay, I will answer this, Vasudevanji. Okay, so the point to understand is there is always a smart calculation involved to get high return. And here, our smart calculation is invest in equity markets, but without protection, never do business. Right? Okay, so that's the point to understand that invest in equities, but always remain protected. Okay, now Vasudevanji has a question that why there is a reduction of 5% in spite of premium. Sir, the reduction of 5% is just because of that premium. Otherwise, your value would not have gone down only. The cost of running this business is the premium that you are paying. Are you getting my point, Vasudevanji? So this is the risk. Why only 5%? Because 5% we have paid as a premium cost. So if market goes down, what you max lose is the cost of protecting that particular portfolio. Is this clear, Vasudevanji? Give me a yes. Give me a yes. Okay. If there is any more questions, we will take in FAQs as well. Okay, let's move on. So here up till this, we understood 2 points. One, we should invest in Nifty. Second, we should always be protected. Now we come up to the exact product which is known as index long-term strategy. Okay, before that, let's meet this Mr. Warren Buffett, who has given two rules of making money. Rule number one is never lose money, and rule number two is never forget rule number one, right? So this is what is pushing you to think of protection, never lose money. Okay, now I will present you one more poll, which is, have you ever, do you understand the basic profile of call option and put option? Okay, so you can start participating. Everybody. Okay, yes. Okay, great. Yes. So we have 63% people who have participated, who have done something in call options and put options. Great. Even if you have not understood, no worries. I will know how much level I need to go for explaining you this product. Okay, no worries. Please participate. Everybody. I'm looking for participation from everybody. I will close this poll in 15 seconds. Okay, everybody, please participate so that we can know what level of understanding we have from the audience and we can explain the product. Okay, great. 69% people know what are calls put option, put option. Great. 71%. Great. Thank you. So I'm ending this poll in just 5 seconds. 1, 2, 3, 4, 5. Thank you, friends. Okay. So now what I'm going to do is I'm going to present you the exact product which is known as index long-term strategy, and I'm explaining you the relax plan. Say for example, there is an investor who wants to invest 1 crore rupees. So what we do exactly in his product? So what we do is we divide that money into two parts. One is kept for 30 lakhs in equity and 70 lakhs goes in debt. Now from this 30 lakhs equity, what we do is we immediately purchase index ETF. Now because most of you know equities, you must be knowing there is something known as index ETF, wherein these funds are traded on exchange and they have invested absolutely in the same way as in index, right? So what you have done is we have purchased index ETF worth 30 lakh rupees and which goes into your DP. So first thing, we invested 30 lakhs and they are back into your pocket. Okay, now on this 30 lakhs, what we do is we purchase futures worth 70 lakh rupees, right? So now you have total investment of 1 crore. Okay, so now what, it's something like saying, so for example, you purchase a property worth 1 crore and you have invested 30 lakhs and 70 lakhs has been invested by bank. So now you have a total property worth 1 crore. Now if market goes up, you will make money on 1 crore, and if market goes down, you will lose on 1 crore, right? Now we don't want to lose on 1 crore. So what we do is we will immediately hedge our downside by paying 5% premium. So this is the first cost of this product, which is 5 lakh rupees on 1 crore portfolio. Okay, so this is the first cost that I pay. Now there is one more cost that I'm going to pay because I have taken funding, and that is the interest cost. Now if you will see, here we are getting funding at just 5% per annum. I will make it clear here only. We are SEBI registered investment advisor, so nothing is going to come from our pocket. And Everything that we are talking about is coming from exchange. The index is from exchange, the funding is from exchange, the protection is from exchange, and even the debt that we are going to talk about is going to be from exchange. So you can trade it on any member that you wish to. Okay, so there is no third party involved. Now what we are talking about was, now we get funding at around 5% per annum. So now we have taken 70 lakhs on 5%, so we are going to have another cost of 3.5 lakh rupees. So your total cost is going to be 8.5 lakh rupees, and in 8.5 lakh rupees you have got two things: one is protection, second is funding. Okay, now this whole thing has been worked upon in just 30 lakhs. So you still have 70 lakhs in spare. We will park that in debt. Okay, so we will get an around 7% per annum as a debt interest. So you will save 5 lakh rupees on debt. So now your total cost is just 3.5%, 3.5 lakh rupees. Is this clear? Everybody, is this clear? Give me a yes. Now, in this 3.5 lakh rupees, what you know for sure is, now if market goes up, you will make profit on 1 crore. And if market goes down, you're going to lose maximum 3.5 lakh rupees. Right? Right? Okay. Is this clear? Give me a yes. Everybody. So that we know if there is a point to understand. Okay. Fair enough. So now, say for example, somebody has invested in uh, full 1 crore. Now, what we do is we are investing 30 lakhs in equity and 70 lakhs in debt. Now, somebody might say that you are earning just 7% on this debt. Why are you doing that? I do have an opportunity. I do have NCDs where I can get more than 9%. So then we offer them another plan, which is known as a basic plan, wherein everything on the 30 lakhs part remains same. Your cost still is 8.5 lakh rupees, but the 70 lakh rupees which you can get, which you can generate more than 9% on NCDs, or you can have some loans that you can repay, or you can use in business and generate around 9% per annum. So you as an investor end up saving extra 2%. So you will have 6.3 lakh rupees as a saving. So your net cost will go down to just 2.2 lakh rupees. Just 2.2 lakhs. Okay, so this is also a possible variation of the same strategy. There is third possibility as well. Now somebody might come and say that, is there a possibility of increasing this 70 lakhs? Is there a possibility of increasing this 90 lakhs? Is it possible? So there is one more possibility, wherein instead of parking 70 lakhs and 30 lakhs in index ETF, you can straight away go and invest 30 lakhs in stocks. If you, for example, you have some stocks to invest and you can pay just 10 lakh rupees. So what you have is, you can immediately buy futures worth 100 lakhs on the collateral of this 30 lakhs only. Right? So what happens is, you have 100 lakhs. So now your total investment is still 100 lakhs. You will purchase, when your market goes up, you will make money on 1 crore. When market goes down, you will lose on 1 crore, which we are going to protect at 5% per annum. So you will pay 5 lakh rupees. And the funding cost is now going to be 5 lakhs, because you have taken 100% funding. Okay, so in all, your total cost will be 10 lakhs. Now, in this 10 lakhs, you have got two things. One is protection, second is funding of 100%. Now, this you have got, make sure to remember that this you have got only because you had this 30 lakh stock, right? So now you have protection and finance when you have saved 90 lakhs interest. Now you can save interest on 90 lakhs. Let's say you save 9% per annum, so you will have 8.1 lakh as saving. So in all, your net cost will be 1.9 lakhs, even lower cost. So these three variations are possible in the whole product. Okay, now I am pushing one more poll for everybody to answer. Do you have any kind of loans, like car loan, business loan, CC, term loan, loans from friends or relatives? Okay, great. Why I'm asking this? Because if you have loans, you can very well beautifully use this strategy by going for power booster. Otherwise, you can look for relax plan or a basic plan. Great. I'm getting answers very fast. Awesome. Great. Okay, you have another 15 seconds to answer this question. Participate in the poll. Everybody. Okay, great. So we have 70% people who have not taken any loan, who don't have any loan outstanding, and we have 30% people who do have some sort of a loan. Last 2 seconds, 2 and 1. Thank you, friends. Thanks a lot for your participation. I'm ending the poll. Great. So we have most of the people who don't have any kind of a loan. Great. Now, say for example, we look at the original strategy, which was investing 1 crore at one shot, as we do in mutual funds or direct equity, whatever. Right? So let's say somebody did it for last 17 years, what would have his return? So now if you will look at it, let's say somebody started with an investment of 1 crore. So he will invest 1 crore rupees and index was at 11,000, 1100. Now market went up. Market increased by 71%, but we made just 68%. Why just 68%? Because we do have a cost to repay, right? Now, from that we made some profit. Market went up by 11%, we made just 7%. So whenever market goes up, we make a bit less only, always. So this way we kept on making some profit. We did make some losses, right? Then some profits and losses. Now if you look at it, in last 17 years, your 1 crore became 18.5 crore rupees almost, right? And even more important point is this: if you look at 2007, market was at 6100. In 2008, it went down almost below 3000. So there was a fall of 52%. But how much did we lose? Just 4%. Why just 4%? Because we do have that protection, right? Here, from market 6100, it went to 4600, 2010 to 11. Market lost 25%. We lost 4%, 3%, 2%. So if you look at it, the whole profile, you will find that we have not taken any risk beyond 4% in any year. But if you look at the annual compounded return, you will find that you have made 18.9%, right? So if somebody is looking for this kind of a profile, when he will be happy with a 15, 16, 18% returns, and he don't want to take a risk of more than 7, 8, 10%, he can very well look at this product. If you have if you are looking for your retirement planning, if you're looking for your education of kids or marriage, you can look for this kind of product where you don't want to lose big and you still want to make handsome returns. So this is the risk return profile of the strategy. Now if you look at this product since 2014. Now, this is a real example wherein our investors started in 2014 and we made both them 100. I mean, Nifty was at 100 and ILT was 100. We just make it to make it comparable, right? Now, if you will see, the chart has kept on increasing. We have kept on beating index and we have beaten it by more than 40% by 2020, June 2020, right? So in 4 years, in 6 years, we have beaten it by around 40% odd. Okay. Now, if you look at it, I will just take you to the slide so that you can understand. In 2014, market was up by 14%, and your NLV, I mean the client's NLV was also up by 20%. Market went down, went back to 90% of the starting point, while we were still at 112%. Then again, market went up. It went to 114%, but we went to 141%. So we started beating the index. Market fell down to by 103%, around fall of 11%. We also fell. But when market went up by 150, we were at 176. Market again fell. We also dropped, but the drop, if you will see, if you will observe, the drop is always lesser than what is happening in market. Okay. Market went down by to 130. We were at 165. Now, very important here, if you will see, market went to 156. We were at 187. Now, this is very important to understand. In March 2020, market went to 98%, a reduction of around 60% odd in market, while we fell by just 16%. Are you getting my point? And market went back to 158% now. I mean, it's almost back to 12,000 plus, and we have beaten the original level by 7%. Are you getting my point? So whenever there is a fall, we don't fall that much, and whenever there is a rise, we do participate in rise. So that's the whole idea. Are you getting my point? Everybody, give me a yes. Is this clear to you? Everybody. So over the years, if you will see, From 100, index went to 158, while from 100, we went to 195, almost on the bringe of getting your money double, in spite of no big fall in your value, right? So this is the whole beauty of having a protection. Okay. Now there are people who looking for systematic withdrawal plan, wherein what they want is, I will invest today, but I want to get some money back every month, year on year. Okay, so we do offer that kind of a plan as well, wherein you can invest 100% here. So for example, you invest 1 crore rupee, so your initial investment will be 1 crore, and you will get a monthly payout of 0.5% every month, year on year. Now if you do this kind of a plan, what will happen to your returns? So this will be a bit different. If you look at it, this is what you are going to do. 1 crore you will invest here, and you will keep on getting 6 lakh rupees per annum, because 50,000 per month is 6 lakh rupees per annum. So this is what you are going to get, and after 17 years, your 1 crore is still 15 crores, right? And you have got 1.2 crore over the years as well, right? So you keep on getting money as well, and your money still keep on growing as well, right? So this is the beauty of having a systematic withdrawal plan, where your immediate cash needs are also satisfied, and still your money keeps on growing. Okay, so this is what you can opt for if you're looking for some systematic withdrawal plan. This will suit to people, this will suit to people who are on the brink of, let's say, retirement, or there is a 5 years they are looking for retirement. So these kind of people can look for this kind of a plan. When your initial investment will be 6 crores, you'll get an annual withdrawal of 6 lakhs. So your 1.02 crore is the annual withdrawal, and still your net liquidation value will be 15 crores over 17 years. This is the past data that we can look at. So this is your overall net P&L, 14.97 crores. Okay, so this is, you can compare with parking your money in FD with an SWP. If you look at it, in 2002, had you invested a crore of rupees here in FD and here in SWP, and you have kept on getting that 6 lakh rupees annually, your NLV after 17 years will still be 1 crore, while here it will become 15 crores, and your P&L will be 1.02 crore in FD, while here it will be 15 crores, right? So that's the difference between, you are getting an safety of FD and you are getting a returns of equity. Fair enough. Now if you look at the minimum investment of this product, you will see that the minimum investment of this product is one lot of Nifty. Okay, so one lot of Nifty is like what, 9 lakh rupees as of now. So this is the minimum investment. Okay, in relax plan it is like 30%, 100% you will pay. In basic you will pay 30%, and in power booster you have 30% plus chance stock, 10% check, right? So what you will pay, if say for example you go for relax plan, your check payout will be 9 lakh, while in basic plan it will be just 2.7 lakhs, and in power booster it will be 90,000 rupees. Okay, so this is the minimum check that you can start with. And here in
सॉरी
relaxer
टू
you,
डिस्टर्ब यू सर, सॉरी टू डिस्टर्ब यू, लेकिन आपकी ये स्लाइड जो है ना वो सिस्टमेटिक विड्रॉल प्लान की दिख रही है.
my slide is not moving, is it?
No, it is moving. It is
It's
moving.
moving, right? Yeah, okay,
ओके,
thank you, thanks a lot.
थैंक यू.
Yeah, okay, so thank you, sir. So in relax plan, if you will see, you need a check of 9 lakh rupees, while you don't need any extra shares to park in. If you go for basic plan, you can still have 2 lakh 70,000 rupees. You don't need any shares. But if you are looking in for a power booster, you need a check of 90,000, just 90,000, and you can use 2 lakh 70,000 worth of your shares, and you can start your investment. So this is the minimum investment that you need to do to start this product. These are our commercials. We do charge for a half yearly fee. This is a SEBI requirement, so we are looking in for that only. So if you go for a 1 crore investment, you just need to pay 0.75%. That is just uh, 75,000 rupees as an investment for a 1 crore rupees uh, investment. From 1 crore to 5 crore, it is 0.625%. and from 5 crores and above, it is just 0.5%, half yearly or 6 months plan. Okay, these are your commercials. Now we have just put in one slide, a small slide, which says how do we compare with mutual funds or PMS, because these are the products wherein you can give your money for being managed in equity market. So these are the general options that you have. You can go for a mutual fund, you can go for PMS, or you can look for ILTS as well. Now if you look at the expense ratio, you will see that in mutual funds you can find the expense ratio as high as 1.75% on annualized basis, while in PMS, it goes to 2.5% as well. But in ILTS, your average cost expense ratio will be just 1.25%. So we do take pride on having the lowest possible cost in the industry for managing, for having a managed portfolio in equities. Okay. Now, if you compare with other investments, you will see that in equity, mutual fund and PMS, your initial investment is 9 lakh. In index long-term strategy also, your initial investment is 9 lakh. So it is similar, right? But if market rises by 100%, say for example, market doubles, in equity, on an average, your money will also double. So it will become 18 lakhs. While here, it will be just 17.7 lakh because we are paying a cost for increase in for remaining invested, right? So you will make less, but it is very similar. But if market goes down by 50%, you will see that you have your portfolio will become 4.5 lakh rupees. It will also fall by 50%. But here in index long-term strategy, it will not go below 8.7 lakh rupees. Now that's the beauty. I mean, you are making money when market goes up, but when it goes down, you are not bearing a big pain on that, right? So this is how we compare index long-term strategy with other equity investments. Okay. Now, if you will look at the various plans, how, if for example, somebody is doing a minimum lot, so his initial investment will be 9 lakh, his returns will be on 9 lakhs, his annual cost will be around 35,000. He will not save any interest because he have parked everything here, right? So his net cost will be 35,000. Now, if you go in for basic plan, your initial investment will be 2,50,000 only. Your returns will be on 9 lakhs and your annual cost will be 76,000. But then you are going to save interest on 6.5 lakh rupees. So your interest saved will be 58,000 rupees. So your net cost will be 18,000. I mean, lower than the relax plan. And if you go for a power booster, you will invest 2.5 lakh as stock and just 1 lakh as check. Your return will be on 9 lakh rupees. Your annual cost will be 90,000. But then you're going to save interest on 8 lakh rupees. So net, you will be saving 72,000 and your net cost will be 18,000 again, right? So you can select either of these plans. Why I'm making it more and more clear so that you can visualize what will be your cost and what is the difference between a relaxed basic and power booster plan. Fair enough. Now I will just summarize this product so that we can open up with for FAQs if you have any. So the features of this strategy are, this is a combination of equity and futures. It is downside protected. It's an index based strategy. That is why it has a lower risk profile. It has a strong past record. You can see your live account. We as a company offer you a back office wherein you can see what is happening in your account on a daily basis, right? You can offer systematic withdrawal plan. There is no lock-in period. I mean, we do suggest you invest for around 5 to 10 years, but say for example you invest today and you want to take an exit 3 days after, you can get your money back in just 2 to 3 days, and it is always in your own account. Okay, we have a dedicated team to monitor your portfolios. We do have a systematic advisory through algorithms. This can be used for retirement and higher education. And most important, the whole product is traded in your own account. So you do have control from the very first day. You don't need to part from your money on any given day, right? So it is always in your control. If you want to get more updates on the product, you can simply message, you can click on this link. I'm just sharing this link with everybody, right? If you will click here, we will keep on updating you on the new products, on the new things that come into FinIdeas ideas, right? There will be a form. We request you to fill in this form, where you just need to fill in your basic detail and a bit of your more details, so that your annual income, how long do you want to remain invested, are you looking for more investment, risk tolerance, are you interested in the strategy. Rest assured, if you mark yes that you are interested in the strategy, then only you will get a call from us. If you are not interested in the strategy, we can very well, we are not into, cold callings, right? So if you are interested, you want to know more about the strategy, please fill in this form with your interest, yes, and send it to us. Our team will get back to you. Okay. uh, why FinIdeas? We as a company, we are a SEBI registered investment advisor, right? So you are dealing with SEBI approved agencies. Okay, we are giving you an online back office for this strategy, so that even if you are trading multiple things in your account, you can always have a bird eye view of what is happening in index long term strategy, because we are going to provide you with those specific trades and specific results. We have more than 18 years of equity market experience, and we do have access to online algorithm advisory portal that we offer it to you. If you want, you can analyze more on that portal. Okay. Now, why do somebody needs an advisor? I mean, that at times this is a question. Okay, we will think advisor is important because he will give you new ideas, because he knows the exchange rules. There are so many rules that are changing day in and day out by SEBI, right? So you must know what are the exchange rules, right? We do provide you strong research. We have the technology. The advisor do have the technology, so that they can improve on your returns, right? We provide you easy reporting. We suggest you best suitable trades, right? An advisor will help you in cutting your cost. I mean, returns may not be in your control, but what is in your control is reducing your cost. That is always in your control, right? So advisor will help you cutting the cost, right? They can help you advise on tax benefits. They do have that experience, and they are always ready for disaster management. If there is a big disaster in market or some way other way around, the advisor can always help you out on how to get out of it. So these are the things why somebody needs an advisor. Okay, what do our clients say? I'm just stating you, these are what our clients saying, right? We have a doctor who is invested with us since last 5 years, and they do have faced all the falls which has came into last 5 years, and still their fund is growing and multiplying, right? This is one of our esteemed partners, Sanjay Vaishya. He's into investment advising since similar 2006 4, like that, right? And he says that algorithms are very important for advising the trades, right? We have Shalini Jain. She's also invested in this particular strategy. We have been taking pride on giving answers. We do believe in the strategy that whatever you are investing into, we first explain it to you, we make it clear to you, and then only the investment starts. Not like once you start your investment, then we will start explaining, right? So this is how our clients are saying. Now I am opening the forum for question and answers. You can write your questions in chat, and I will be very happy to answer your questions. If you have any of the questions, you can very well ask us here. Okay, okay. Yes. Okay. We will request you, by the time I'm just placing a Google review form for you all. We will be very thankful if you give us a review on Google. How did you find the product? What was your understanding? How did you like it? That will help us a lot to make it more clear, to improve on things. So you can very well write it. Okay. Okay. Vasudevanji is asking, is fall point to point or rolling any point of time? Okay, so I think what the question is, Vasudevanji, is it the strategy is year on year, or do you have some rollovers during the year? Is this what you're talking about, Vasudevanji? Give me a yes. Yes. Okay. So we do have some systems wherein rollovers do happen. We do have advisory wherein if there is big movements in market, we do advise on rollover, right? So that is there. And if you want to know more on this, you can very well go with our KYC, because SEBI asks us for doing a KYC and then going into a specific details of the strategy. So if you want to know more, you can very well click on the KYC form that we have given. I'm just sharing it again, so you can very well know this. I believe you are clear with the answer, Vasudevanji. We do have that. There are movements. If there are big movements, we do roll the points. Is this clear, Vasudevanji? Okay. 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 Please let know what we have discussed. Okay. Anandji has one question. The 5% was just an example, or is it actual? Anandji, this 5% is the actual cost around. I mean, it may be from 5.5 to 6%, or it may be 4 and 4.5. From last 5-6 years, I think from 2014, we have been observing these premiums. They do range between these lines only, right? We have traded in 4% as well. Now the movement is more, so we are trading in 5.5%. But these are on the similar lines. I mean, we are using the same strategy in Nasdaq as well. There, the premiums are still similar, right? So if you want to trade today, you can very well get a trade in 5%. Is this clear, Anandji? Yes. Okay, Anandji has one more question. Is the validity of this is for 1 year? Yes, the 5% premium. It's like you take a mediclaim, right? You take a mediclaim for, you pay a premium, so it is valid for 1 year. Then you repay the premium and you extend it the validity, right? So this is 5% for 1 year, and then you keep on rolling it over every year to year. Is this clear, Anandji? Okay. Now Vasudevanji is asking, please let know what you have discussed. Vasudevanji, I mean, you're not clear with the answer. Is this what you're saying? Your question was, is the protection December to December, or you can have this protection in between as well? I mean, can I move my points from, yes, regard to PowerPoint assumption? Okay. So what I was saying, see, we saw an example of 10,000 to 12,000 to 10,000. This is what you are asking, Vasudevanji? Yes. Okay. So that was an example wherein you move from 10 to 12, 12 to 8, 8 to 12, 12 to 10. That was a point to point example. I mean, if this happens at the year end, very well. If it happens during the year, then also if you invest at 10,000, and let's say, for example, I will just give you an example. Let's say in Jan 2020, you invested at 10,000. Okay, market went to 12,000. So your 1 crore will become 1.2 crore. Is there any question on that? Right, it will become 1.2 crore. And you do have very well, you are very well within your rights to shift your protection. That can be done. There is a system for that, there is an algorithm for that. But my answer to your question is yes. I mean, if the points have moved during the year also, the shifting is possible. Now is this clear, Vasudevanji? There may be some premiums, Vasudevanji. Okay, Anandji is looking for, can you share the presentation with us? Anandji, can you please fill in the feedback form? Our team will connect with you. Then only we can share this thing to you. Okay. So you just fill in this form and you can, our team will very well connect with you. Okay, okay. Fair enough. So if you have any more questions, you can fill this form. Our team will connect with you and answer the questions. You can simply start your investment planning. We do have a profile, the portal where you can just simply go, select your exposure. How much do you want to pay now? Because you had three options, 100%, 30%, or 10%. And based on that, you will get answers on what is the current cost of the investment. These are our upcoming events in 15th December. We are having fundamentals of futures and options market. There were many people who didn't know options. So I will request you all to fill in this form, and we will you can, okay, Suresh, I will just answer this question. Okay, so you can share, you can click on this link, fill in this form, and you can attend this webinar. This will explain you what are derivatives, what are futures and options, simple hedging techniques, how to reduce your risk, and everything that you should know about options. Okay, Suresh has asked how SIP works. Suresh, SIP works in a very simple way. You just start your investment with 1 crore and you can start getting your uh, withdrawal in 50,000. So this is one way. Now there is another way wherein you can keep on investing month on month, right? So because if you're paying 30,000 today and your investment is of 1 crore, you need to pay that off, right? Say for example, you purchase a property worth 1 crore, right? And you pay 30 lakhs today, you need to keep on paying in installments, right? So here also it works. You can start your investment with 1 crore and you can keep on paying your SIPs, right? So that will have you an advantage of full 1 crore and your payment still is on the slower side. Is this clear, Sureshji? Is this clear? Give me a yes. Okay. Thank you. So these are our upcoming events. We do have on every Thursday 4 p.m. We do have our this webinar on Thursday 4 p.m. and on Sunday 10 a.m. So if you want to register, you can very well click on this link of ILTS web and you can register. We are thankful to these partners of ours from India Cements, Chennai, Ahmedabad, Surat, Mumbai, Dubai, who are continuously helping us to spread the word across the globe so that we can help people becoming financially free, right? So these are the partners of ours. Okay, now I'm pushing in one last poll for you all. While investing, what is your primary focus? Are you looking for returns or your primary focus is on safety? Everybody, yes. Okay, okay. Great, great. I'm starting getting answers. Okay, people are looking for safety. It is very nice. We must look for safety. And do people do look for returns and they are looking for returns as well. Right? So we are having safeties and we are having returns. Okay, okay, great, great. Everybody, please participate on this. Great. Because if you are looking for safety, I believe this will really a product that should be in your portfolio, in your investment portfolio. Because here the primary focus is on safety and returns are the byproduct of the working. So if you have a good working, returns are bound to come. Okay, thank you. Last 4 seconds. Three, two, one. And I'm ending the poll. Thank you. Reviewers on Google, we will be very thankful to you. If you have more queries, please send SWCA and your name at this number and we will get back to you. Thank you, friends. Thanks a lot. I'm just continuing this webinar for another 2-3 minutes. If you have more queries, you can answer. We will be happy to answer to you.